Well, hello and welcome to, thank God it's Friday, Bloomberg Quint's weekly edition where we bring to you market experts' views. And this time around, we are being joined by Marc Faber, the publisher of Gloom, Boom and Doom, who is rather known for his uncanny views. Marc, thank you so much for joining us.
My pleasure, thank you.
Marc, one asset class that you've always really been bullish on has been gold, and the love of Indians for gold is very well known. So does that really make you really like India, is something that we know, but I will come to that later. What do you really make of the recent sell-off in gold?
Well, basically, we have volatile markets and they go up, and we have a lot of leverage in the system. Hedge funds borrow money to buy gold, silver, equities, bonds, and so forth, and currencies. So if you look at the pound sterling, over the last 2 years, we dropped almost 30%. So we have this volatility. People say, well, the markets are not volatile, but that's not true. There's a lot of volatility. And I think that the positioning in gold was heavily long. And you have to see some hedge funds, they know what the positions of other hedge funds are. And so when they know a hedge fund is heavily long gold on margin, they may squeeze that position out by selling gold. And then the hedge fund that has the large positions may have to dump gold and the price goes down and then they can cover.
Well, Marc, investors around the world are keeping an eye on two events in the United States. The first one, of course, is the US presidential election. And for now, we know that Hillary Clinton has edged Donald Trump to a certain extent in terms of probability of winning the US presidential election. In your opinion, who is a better candidate as far as the economy in the US is concerned and its implications on the world?
Well, I think it would be good for the world if we had a US president that is not a neocon and that is not guided by people like the Bush family and Dick Cheney and so forth, but someone who is prepared to see the world the way it is. The world is not the way it was 100 years ago, when Western powers were able to colonize the world and impose their will. Today, we have countries, as you know, like India and China, and also Russia, that have become very powerful. And so we have to negotiate with these countries, keeping in mind their perspective, not just our perspective of the world. And this is something Hillary Clinton just can't do. She was Secretary of State, so we know what her record is. She supported the invasion of Iraq. She supported and launched basically the invasion of Libya. She supported also the nation building in Egypt and the war in Syria. All major disasters. And so I'm saying to myself, maybe after all, Trump is a better choice.
Okay, Marc, do you really believe that Janet Yellen will hike interest rates in December, at least to keep credibility?
If Hillary Clinton is elected, I very much doubt that she will increase interest rates. If Mr. Trump is elected, I think the likelihood of her increasing rates is very high.
But under those circumstances, Marc, even if they do, let's say, for example, and assume that they've hiked rates by 25 basis points, how much leeway do they have to increase their interest rates by? Because as per our understanding, you do not have a good view of the US economy. So can they actually afford to hike rates beyond that?
Yes, my view is the US economy has been slowing down over the last 12 months and corporate profits have been coming down over the last 12 months and so forth. So it's not a good time to increase interest rates. On the other hand, they went to almost zero interest rates in December 2008. So in December 2016, we're 8 years at almost zero interest rates. I mean, the economy must be stinking if you can't increase interest rates during 8 years of an expansion. Something is wrong. So my view is they should have increased it already in 2011, and basically they should increase it now. I think on balance, the zero interest rates, and now there are many voices, not just one, many voices that propose negative interest rates. In my view, on balance, it's rather negative for the economy.
Mark, you've not really been a fan of equities, but you do believe that some of the global central banks are going to continue to print money and infuse liquidity into the global system. So doesn't that really strengthen the case to invest in equities?
Well, I think that I was not a fan for now several years of US equities. But I always said I think that emerging markets over the last 12 months have become relatively attractive. And so this year we had the Philippines, Thailand, Indonesia, Vietnam, all up in the order of 15 to 25%. So I think we have to kind of look at the world. There's plenty of money floating around this world. And one day it goes into commodities, and then another day it goes into equities, and then it goes into some currencies, and then it goes into bonds and so forth. So we can't be overly dogmatic. And number two, I really believe the Fed and other central banks, they have no option but to print money. The whole system collapses if they stop printing money. And so they'll keep on printing money. Now, over the last 18 years, 1998 to now, the balance sheet of major central banks have gone up by 16 times. I think they can go up by another 20 times, or maybe 30 times, or maybe 100 times. If you print money, you really can print money. The impact on the economy is, of course, not very good, but you can do it.
Well, so that brings me to my next question, Mark. Where does India stand in the emerging markets basket?
I beg your pardon? Well, basically, as you know, at present, the Indian economy is growing strongly. Maybe not as strongly as the government is publishing, but it is growing more than most other countries in the world. So I think that the Indian economy within the emerging market complex is probably relatively attractive in terms of macroeconomic development. When we look at valuations, that is where the problem occurs, because good companies in general are not inexpensive. They are selling at 30 times earnings, up to 50 times earnings. So I think in India, if you want to really make money, you have to go to second line shares and focus on sectors. In the last few years, as you know, the world has gone into an indexing madness where people index. They just put money into an index. I believe the next 10 years will allow active managers to make a lot of money because they can move from one sector to another. Now, some will outperform, and some will underperform. But at least they have an opportunity. If you just index, usually you will underperform the index.
Mark, what ideas or themes do you like in India? Which of them do you think really hold some potential to do well?
Infrastructure has a lot of potential, both in India for port facilities, roads, and then you need bridges, tunnels, and then you need the infrastructure for tourism and for domestic airline passengers. So you need to build hotels, airports, and so forth. So that is a sector that, in my view, is very attractive. Also, real estate in secondary locations, weekend homes and so forth.
Mark, what about consumption? Because that's really a theme which has really performed very well over the past year or so. What is your view on consumption related areas?
Well, as I said, in India, there are some expensive stocks, and the same applies to Thailand and to the Philippines. The consumption, by now, every man, woman, and child knows that consumption in Asia is going up. It's not a terribly great insight, but this is happening, of course. You don't need to be a rocket scientist to see it, that consumption is going up. But anyway, that has led consumer-related stocks to go up very substantially. And in the process, they have, in some cases, become rather expensive.
Okay, just two more questions, Mark, from our side. The first one, of course, is the new problems emerging for Germany, that is in Deutsche Bank, where one of the biggest banks in Europe's strongest economies have started seeing some problems. Do you have comments on this? Can you tell us what's happening in Europe right now?
Well, basically, the crisis in 2007, 2008 occurred because we had excessive credit growth and because banks in Europe and, of course, in the US changed their nature from being essentially institutions that accept deposits and then make loans to people into big institutions that gamble with clients' money. And so the first problem occurred with Bear Stearns and then Lehman Brothers in the US, and then AIG, and that was then bailed out. But the bailouts then didn't lead to a cleaning of the system. The banks were allowed to continue to gamble with essentially their capital. And now with zero interest rates and with more leverage than in 2007 in the banking system and in total debts as a percent of GDP, now there is a problem with Deutsche Bank. And I suppose, but I don't know because I'm not an auditor, I suppose the bank is basically bankrupt. But the government will not let it go bankrupt. You understand? They will kind of engineer some kind of a bailout. Either the government can ask the private sector to help Deutsche Bank, or the government can help Deutsche Bank. I mean, it's not that the bank will disappear. But I think what will happen over time is that these banks like Deutsche Bank and Credit Suisse and UBS and so forth, and JP Morgan and Citi and so forth, they will not be allowed to gamble in all kinds of speculative markets, whether it's equities or swaps or currencies or interest rate swaps and so forth. So I think that in general we'll move over time to a sounder financial system. But it's not going to happen overnight. It will take a lot of time.
Mark, we saw the pound flash crash today, fell at over about 6% in early trade today. What do you think really holds for the two most important currencies in the European region, so the pound and the euro?
Well, my friend who knows more about Britain than I do, he was arguing that based on economics, and that is, he argued that long before of Brexit, that because of economic conditions, the pound sterling was the most overvalued currency in the whole world. And so now it's collapsed. Now the people will say, the analysts and the government and the people that didn't want Brexit to happen, they will say, see, the pound has collapsed because of Brexit. And so Brexit is blamed for that. But actually, Brexit has very little to do with it. It's the currency that was overvalued.
Well, Mark, I guess that's all we have for you, and I want to thank you very much for your time. And as for you guys, well, I hope that you found that conversation insightful. We've got a lot of takeaways when it comes to the global markets, commodities across, as well as several other things where you can take an interest in. But that's all that we have for you on this edition of Thank God It's Friday. You can, of course, log into our website to get a lot more that's happened in our conversation. And otherwise, you can always join us back next Friday on yet another edition of Thank God It's Friday.